Same person, 10 different crimes, 10 different sizes of the same machine. Here's how it starts, with a 15-minute afternoon. Level 1. Structuring, $18,000 in a duffel bag. Rule 1 sounds too dumb to be true. Never deposit more than $9,900 at once. Go $1 over $10,000 and the bank has to report you, automatically, no suspicion required. So you split $18,000 into 2 deposits, 2 branches, 2 days. Congratulations, you just committed a separate federal crime, structuring, whether or not the cash itself was ever dirty. Here's the part nobody warns you about. This is the easiest level to get caught at. Banks don't just flag deposits over 10 grand, they flag deposits that cluster suspiciously just under it. One teller recognizing the same face making $9,800 deposits at 2 branches in 1 week doesn't need a legal threshold to get suspicious. She just needs a pattern, and structuring almost always becomes one. That triggers a suspicious activity report, no proof needed that the money's illegal, just that the pattern looks wrong. Most small-time laundering dies right here. The money's in a bank account now. It is nowhere close to clean. Level 2. The cash business, buying a laundromat. So you buy a laundromat. Not because you love laundry, because a cash business is the foundation everything after this depends on. The laundromat really takes in $4,000 a month. You report $6,000. That extra $2,000 in dirty cash just became normal revenue, and you pay tax on money you never should have had, which is somehow the whole point. This works because no auditor wants to spend months secretly watching a laundromat unless something bigger is already suspected. But it caps out fast. You can only launder as much as a tiny storefront could plausibly earn. A business claiming to wash $6,000 worth of laundry a month, buying supplies that barely cover half that? That mismatch is exactly what turns a routine tax audit into a much bigger financial crimes referral. A business claiming to wash $6,000 worth of laundry a month, buying supplies that barely cover half that? That mismatch is exactly what turns a routine tax audit into a much bigger financial crimes referral. Level 3. Shell companies and fake invoices. The laundromat can't absorb enough anymore. Time for a company that doesn't need to make sense to anyone, because there's no storefront, no customers, no street. It exists to invoice your real business for consulting services that were never performed. Your real business pays. The money moves from a company that has to explain itself to one that never does. This is called layering, moving money through transactions specifically to blur where it started. One fake invoice looks like normal spending. 20 of them through 6 shell companies start looking exactly like what they are. Setting this up correctly isn't a DIY move. It needs an accountant or lawyer who knows exactly how far they can go without technically crossing the line themselves. That's a service, and services like that have a. Investigators don't start with the invoices. Those are built to look clean alone. They start with the registered agents. A dozen, unrelated, companies sharing one mailbox, one accountant? That connective tissue is what actually builds the case. Level 4. Real estate. Real estate loves money launderers for one reason. Property value is an opinion, not a fact. And an opinion is exactly the kind of gap dirty money slides through. Buy it for $200,000, part cash, part mortgage. A year later, sell it to a shell company you also control for $500,000. Nobody can prove that price is wrong. Property valuation just isn't an exact science. That $300,000 gap is now clean profit from a totally legitimate-looking real estate deal. On paper, at least. Cash-only purchases are the favorite move here, because in a lot of places they've historically drawn far less scrutiny than a financed purchase a bank would have to vet. This scales beautifully. One flip cleans hundreds of thousands. Repeat it across cities and shell buyers and you clean millions without ever tripping the cash deposit flags that catch people still stuck at level 1. Level 5. Offshore structures. Domestic methods hit a ceiling fast. Banks, property records, and tax authorities all talk to each other eventually. So you go where they can't. Your money lands in an account owned by a shell company, owned by a trust, administered by a local agent who has no legal obligation, and often no real ability, to know who you actually are. Layering here means bouncing the money through multiple offshore jurisdictions in sequence, and every hop is a country that has to individually agree to share records before an investigator can even see the full chain. International cooperation has gotten a lot better in the last 20 years. But this method still works well enough in enough places, because closing every gap everywhere at once is a lot harder than opening a new shell company wherever the gap hasn't closed yet. Massive leaked document sets from offshore service providers, published through international journalism over the past decade, did more to expose this whole system than years of enforcement, because for once, investigators saw the entire client list at once. Level 6, trade-based laundering will